Entry selection is one of the most important components of strategy development. With a good entry, your profits accrue quickly, minimizing your time in the market and giving you more flexibility when determining trade exits. But with an abundance of indicators available, choosing your strategy's entry can be an overwhelming task. To help you out, this video will illustrate a graphical method that lets you compare the profitability of different entries as a function of your trade's holding period.
For the sake of illustration, let's select 3 simple indicators that are readily available. Each indicator will be used in a counter-trend manner. In other words, go long when oversold and short when overbought. First up, we have the classic exponential moving average crossover strategy. 2 moving averages will be used here, with the fast moving average having a look-back period half that of the slow one. When the fast moving average crosses below the slow moving average, downside momentum is present, and a long trade will be entered. Quite possibly the most popular indicator among retail traders, Bollinger Bands consist of a middle moving average line enveloped by a pair of lines placed 2 standard deviations above and below the average. Long trades will be opened when the price closes below the lower standard deviation line, and vice versa for shorts. Finally, we have the Donchian channels. Popularized by the famous Turtles experiment, Donchian channels envelop the highest high and lowest low over the look-back period. Like the Bollinger Bands, a penetration of the lower line indicates a buy signal. For each entry under consideration, a simple strategy consisting of the entry condition and a bar-based time exit will be programmed. This exit closes the trade after a certain number of bars has elapsed, after which subsequent entries may occur if the conditions are met. For example, for the Bollinger Bands entry, I will buy when price closes below the lower Bollinger Band, and exit the trade after time stop bars have passed. Shorts are symmetrical. Using this strategy, backtests will be run with the time stop parameter optimized from 1 to 100, in steps of 1. The expectancy, or average trade, of each backtest will be used to gauge the profitability of the entry when the trade is held for the specified number of bars. In this way, we can analyze the entry's performance as a function of the holding period. Since we are comparing different entries, a similar look-back period of 80 bars will be used for each entry. Later on in the video, we will look at the effects of varying this entry look-back period. The 4-hour time frame is especially popular among retail traders and will be the focus of our tests. The Pound Canadian, Pound Franc, and Canadian Franc typically exhibit counter-trend behavior on this time frame. Entry performance will be averaged across these markets. Each strategy was subsequently programmed in AlgoWizard and verified using MT4's strategy tester. In theory, stronger entries should contain a probabilistic edge that is larger and more sustained. Nonetheless, with how efficient markets are, any edge is usually transient, and all entries will lose their profitability over time. The entry comparison graph for a 80-bar look-back period is shown here. Personally, it comes as no surprise that the exponential moving average entry is the worst performer. Expectancies remain negative until after 50 bars in the trade. I have tested moving averages ad nauseam and find that they usually only work well for longer-term trend-following strategies. I suspect whipsaw entries are the main drawback of moving average crossover strategies. The Bollinger Bands and Donchian channels perform much better, and there are some interesting differences between them. The Bollinger Bands have a higher rate of profit accumulation until a holding period of 70 bars, after which expectancies begin to plateau and fall. On the other hand, Donchian channels' expectancies continue to increase sharply until they hit a narrow plateau at about 90 bars into the trade. I believe both these entries provide excellent starting points for subsequent strategy development. If you can only pick one and wish to minimize your time in the market, the Bollinger Bands should be a better choice. I have a slight preference for the Bollinger Bands because of the wider expectancy plateau in the 70 to 90 bar range. They also tend to generate more trades than Donchian channels. Of course, you can select multiple entries, especially if your trading is automated. Portfolio trading is a great way to exploit the advantages of both entries. Bollinger Bands and Donchian channels are conceptually different and tend to produce uncorrelated strategies. Entry selection aside, the relationship between expectancy and holding period can give you some ideas for subsequent trade management. For the Bollinger Bands case, the plateau and eventual fall in expectancy after 70 bars indicates that trades should be closed by that point. You may wish to include some sort of time-based exit in the final strategy, or tighten your stops at that point. Also notice how the Bollinger Band's expectancies tend to hover about the break-even point until about 20 bars into the trade. It may be worthwhile to delay your market entry by a certain number of bars, or get better bang for your buck by entering on a limit order. Now let's repeat the previous analysis for the Donchian channels, but with a look-back period of 40 bars instead. In theory, a longer look-back period means more information is used for the entry, giving a more reliable entry signal. I expect the 80-bar look-back to give higher expectancies across the board, but the results here show otherwise. Expectancies only begin to diverge after 70 bars into the trade. I'd still prefer an 80-period look-back over the 40, owing to the far greater expectancies after 70 bars. Nonetheless, higher expectancies do not necessarily indicate a better trading solution. The 40-bar look-back will generate more trades than the 80, and this could result in an overall improvement in net profit. An alternative approach is to plot the strategy's performance as a function of the look-back period, as shown here. Confluence between the two approaches likely means you're on the right track. So there you have it, a simple graphical method to help you rank and select trade entries. 3 basic entries were illustrated here, but you can also apply this method to complex entries containing multiple conditions. Quantifying your entry profitability using these tests, across a broad range of markets, will swing the odds in your favor right from the outset. For a complete and back-tested Donchian channels trend strategy, check out the video at the top right. If you prefer mean reversion with the Bollinger Bands instead, check the video at the bottom.